Let's take a look at the conceptual framework. Conceptual framework is what guides the standards that are set by FASB and the International Accounting Standards Board. There are 4 components to the conceptual framework: objectives, qualitative characteristics, elements, and recognition and measurement. Objectives: to provide information useful to investors, creditors, and others. Qualitative characteristics: to require information that is relevant, reliable, and comparable. Elements: to define items that financial statements can contain. Recognition and measurement: to set criteria that an item must meet for it to be recognized as an element and how to meet that measurement. Let's take a look at this cost principle. The cost principle, also called the historical cost principle, basically says that what we put on our books is at the cost that we paid for the item plus any legal fees that we might pay to own the item of an asset. There are other items within the cost principle, but from the point that we need right now, that is enough. The revenue recognition principle provides guidance to when a company should recognize that sale that they make. And it's very important with the accrual system that we recognize revenues in the same time period that we recognize expenses, which flows into expense recognition, which is our matching principle. And lastly, we have full disclosure principle, which prescribes what a company should report in detail with their financial statements, because it would impact decisions that the users would make. Here again, we're looking at the concept of the cost concept, historical cost principle. What does that mean? If our company purchases this van right here, we have some items that come with this van. We could look at a list price, a purchase price. There are some taxes involved, registrations, recording cost. Which of these items would be included in our asset account? So we're going to have an asset account, and we'd probably label it our new van, and it's a debit balance. And what kind of cost would we put in here? Well, we would put the taxes, and we would put the registration, but most importantly, we're going to use the purchase price, what we paid for it. It doesn't matter what the list price was. And we would also include any cost involved with the registration, the title, recording, etc. So that is the cost concept. And for U.S. accounting, for this course right now, the historical cost of the asset is what is on your books until you sell the asset. Let's take a look at an example. Jason Thompson purchased an office building 10 years ago for $780,000. The building was just appraised at $1.25 million. What value should be used for the building in Jason's accounting records? Support your answer. Well, I hope that the answer you came up with was the $780,000, because that is what's going to be recorded in his accounting records based on this cost concept, or historical cost. Just to make sure that we're still thinking in a business sense, I have provided just a little example to talk about personal use versus business use of assets. Sally purchased a personal computer for use at home. Sally owns a dental practice. She occasionally uses the computer for a task related to her dental practice. However, the computer is used primarily by Sally's children. Can the computer be recorded as an asset in the accounting records of Sally's dental office? Why or why not? The correct response is no, it cannot be. The reason is that it is not primarily used for her business. it is primarily used for her children. In addition to that, the IRS requires that any items that are assets in a business, that they be primarily used for the business, and they will check.